This is Ken Malcolmson with the North Dallas Chamber of Commerce, and I want to welcome everyone to this very special edition of the North Dallas Chamber of Commerce's virtual program. You know, since March 24th, where we pivoted at that point, we've done over 50 programs or committee meetings in a virtual setting. And each one of these events has been insightful and engaging, and today will clearly be no exception. We're fortunate today to have three sponsors of today's special edition. They are Capital One Bank, as represented by Rachel Capps, a board member of the North Dallas Chamber of Commerce, Hewitt Zollers, as represented by Tony Sotheby, also a board member of the North Dallas Chamber of Commerce, and finally, Benefit Mall, as represented by Scott Kirksey, a past board chair of the North Dallas Chamber of Commerce and a current board member. So just a quick logistical item. As we typically do in all of our virtual programming, if you have a question, please issue that question in the chat function. Jeff and I will curate those questions, and then we will actually call on you to actually ask your question if we have the time to do that later on in the program. So with that, I'm going to turn this program over to one of our great partners at the North Dallas Chamber of Commerce, Rachel Capps with Capital One, and she's going to introduce our speakers. So Rachel.
Wonderful. Thanks, Ken. As Ken mentioned, I am Rachel, and I'm Senior Vice President of Capital One Commercial Banking here in Dallas. Capital One is a top 10 U.S. bank and a leading middle market lender in the country. We offer dedicated areas of expertise, a full suite of products and treasury management offerings, and full corporate and investment banking services. We are very fortunate today to have Ollie Shanduk, President and Publisher of the Dallas Business Journal, as our moderator. Ollie and the Dallas Business Journal are not only great friends of the North Dallas Chamber, but Ollie also serves on our board. He's a native of Toronto, Canada, but came to Texas as quickly as he could, and is a graduate of Queen's University in Charlotte. He has been with Dallas Business Journal's parent company, American Business Journals, for 12 years. It is a great honor for me to introduce to you our 13th President and CEO of the Federal Reserve Bank of Dallas, Rob Kaplan. Rob assumed his current role nearly 5 years ago after an 11-year career in academia as Professor and Senior Associate Dean at Harvard Business School. Prior to joining Harvard, Rob was Vice Chairman of Goldman Sachs, where he had a 23-year career in multiple leadership roles. Rob has authored several books on leadership and has also served on the board of multiple institutions like Harvard Medical School, State Street Corporation, Bed Bath & Beyond, Harvard Management Company, and the Ford Foundation, to name a few. Born and raised in Kansas, Rob is a graduate of the University of Kansas and Harvard Business School. Please join me in welcoming Rob and Ollie to today's forum on the economic impact of the pandemic.
Thank you.
Thank you, Rachel, and thank you for hosting us. We're happy to be here. Rob, how are you?
Good. How are you, Ollie? Thanks for having me.
I'm doing great. We have a very interested group of local business leaders, so we'll just jump right in. Okay. All of us have dealt with, what is probably a generational impact here with the coronavirus. Our offices have shifted. We've done all kinds of things differently. How has the coronavirus impacted your office and just your general day-to-day?
Well, I think the Fed generally has been deemed essential services. And so we have about 1,300 employees at the Fed. We've only had in every day our cash people. We run substantial vaults through the district, and we've got to keep that going. And then what goes with it, that is about 70 police officers. Otherwise, we pretty much had all our people working remotely. I've come in every day, but it's pretty easy for me to do. But I'm basically, other than the police and the cash people, the only ones in the building. And in terms of coming back, like a lot of businesses I talk to, we've been able to operate pretty effectively remotely. And as long as we're able to do that, I think it'll be some time before we actually ask everyone to come back. We'll continue to monitor that, but wouldn't shock me if that were sometime, after Labor Day in the fall, and we'll just have to see.
Right. As you can see, I'm still sitting in the home office. So moving forward, what protocols?
And one other comment I'd make is one thing about the Fed in a crisis, particularly, we work a substantial amount locally, but I'm spending most of my time, in addition, working with the other Reserve Bank presidents and the Board of Governors on national programs. I'm the point person on the municipal bond program, for example, which is a nationwide program. We do PPP nationwide. We have a very large PPP effort here in the 11th district. And so I spend a lot of time, which we always do at the Fed, but even more so now working nationally. And I'm on a bunch of teams on various things where I'm at Dallas, but they're, virtually all through the United States.
I see. So, hey, Rob, I read your essay that you published February 18th, the assessment of economic conditions and the stance of monetary policy.
Yes.
So that you published that probably a month before we really got hit by the coronavirus, right?
Yeah.
In that essay, your forecast for GDP growth rate was 2 to 2.25 for 2020. How much has that changed?
So it's changed dramatically. Our estimate at the Dallas Fed right now is that the U.S. economy will contract approximately 4.5% this year. So rather than 2.25 growth, we'll have a 4.5% contraction. Most of the contraction will be driven by what's going on in the second quarter of this year, and that we think GDP will contract on an annualized basis about 35% in the second quarter. We'll grow. We're starting to grow now. Out of that, we'll grow in the third quarter, we'll grow in the fourth quarter, but even with that rebound, we'll still contract substantially for the year.
So the impacts in Q2 are very significant, obviously.
Yeah, historic.
Right. Historic.
Unprecedented.
Right. It's so just shift a little bit to unemployment. So in that essay, or at that time, middle of February, we were looking at unemployment was 3.6%, something like that, and now we're over 15%. The recent employment report that came out on June 5th, it was surprising. It was actually a little bit better than we had expected and anticipated. How does that impact your forecast? How does that report that came out in June impact the forecast? Does it change?
We had expected the narrative I just talked to you about, severe contraction second quarter, growth toward the end of this quarter and into the third and fourth quarter. That jobs report doesn't actually change that narrative. The only thing it did is suggest that people were getting people back to work a little sooner than we'd expected. We thought you'd have very positive jobs reports in June, July, August coming out of this. In a lot of my conversations with businesses, I think a lot of it was because of the PPP. Right? And that many businesses want to make sure that the PPP loan got converted from a loan to a grant, and they didn't know how much time they had. They brought a lot of people back. So I think what you saw is a little bit, by a few weeks, maybe some of the job additions expedited, but it didn't really change. It didn't really change my overall narrative for the year.
So will we see another positive report June and July?
I think we should, yes. We've been expecting, now the unemployment rate you probably read, there's some statistical issues, and what they're referring to when they say that is there are a number of workers that were furloughed, weren't getting paid, but weren't counted as unemployed in the unemployment rate.
Right.
So if you add those back, we think as of May, we're probably in the mid-teens in terms of unemployment. The thing I look at more is called U6, which is unemployed plus discouraged workers who've given up, left the workforce, and those who work part-time and would like to work full-time. That percentage is in the low 20s. Okay, so we think, you're going to see more job growth in June, July, August, through the summer and into the fall. The problem is, even with that growth, we think we'll still end the year with an unemployment rate in excess of 8%. It could be higher, by the way, it could be lower, but what's going to drive us from here, in my opinion, is not as much monetary and fiscal policy, although they have a role to play. It's going to be how well we execute people wearing masks, extensive testing, contact tracing. And at the moment, I think there are a lot of question marks about how well as a country we're executing this. And that's why you're seeing this resurgence. We knew you'd see a resurgence in cases, but the issue is you see such a resurgence that it causes the consumer, which is 70% of the economy, to pull back. And more than that, you and I just talked at the beginning about when people are going to come back to the office. I think it'll cause a lot of workers, a lot of businesses, and maybe even some school districts to say, let's hold off in bringing people back in the fall if this resurgence doesn't get mitigated. And so I'm worried all that is going to slow the recovery.
So I'm going to touch on jobs one last time here. Job growth in Texas for 2020 was forecast at 2.1%. I mean, that's changed significantly, right? And the second half to that question, Rob, is what areas do we focus on to create jobs? Immigration, H-1B, skills training, all that kind of stuff.
Okay, so the Texas unemployment rate so far is better than the average for the United States. We're doing somewhat better, despite weakness in the oil sector, which has been well documented, and that we've got, we can talk about that. We'll talk about that, I'm sure. But the fact of the matter is, a lot of there were job losses across the board this year, but they particularly affected the service sector and small businesses. And so in terms of improving the recovery, where I would be looking in particular is the consumer, the healthcare practices, and increasing the likelihood that consumers are willing to re-engage in going to small businesses, going to retail stores, going to arts, leisure, entertainment, you name it, and that'll help the service sector. And if you talk about an area I'm most worried about, I'm worried again that we don't do these healthcare protocols or execute them very effectively. The communication and confusion over whether people need to wear masks. Are masks even effective? I think there's a lot of confusion out there. There shouldn't be. To the extent we don't execute this well, service sector and small businesses are going to come back more slowly. Now, you mentioned visas and immigration. On the one hand, before this crisis, I've been a big advocate, and I will be again, that we need to grow the workforce faster. The workforce is aging, the population is aging, because we didn't have a lot of labor slack, and so immigration was key to growing the workforce and filling jobs. We're in an unusual situation right now where we've got a lot of labor slack among our existing workers, and we've got to get our existing workers back to work. And so that probably does take priority over everything else right now. We've got to get existing workers back to work. And the problem is, particularly if you're lower income, Black, Hispanic, if you worked in the service sector, you are far more likely to see that you've lost your job, and it's less likely that your job's going to come back. And so we're gonna have to do a lot to retrain people, and many people out there who've lost their jobs are going to have to find jobs. They may not have a job at their old firm. They may not even have a job in their old industry. They may have to redevelop a new functional capability, and that's slow. That takes time. So there's the getting people back to work to the extent possible in their old jobs, and then the second issue is, even if we do that well, which I'm not sure how well we're doing it right now because of the healthcare situation, there are going to be some number of jobs that are not coming back, and people are going to have to get redeployed and find ways to go re-interview and find new jobs, new firms, new industries. And that's going to be challenging, and it may take time.
Rob, you mentioned the healthcare situation. So you've been a proponent for ubiquitous testing and more robust health policy. Why is that such a focus for you?
Well, and mass would be at the top of the list. I'm going to do a program later this week with epidemiologists, and every epidemiologist I talk to, and by the way, doctor also tells me they're convinced if people wore masks widely and it was required, you would have a dramatic reduction in the transmission of the disease. And they think eventually you'd have a lot more confidence on the part of consumers to get on airplanes, to re-engage in a broad range of activities. So I'm at the stage here, we've expended trillions of dollars in monetary and fiscal policy. And the reason I'm talking so much about healthcare right now is there's a point at which more monetary and fiscal policy, particularly fiscal policy, may well be needed. But I think the how well we recover is going to be driven, I think, a lot more by whether people wear masks broadly. Something as simple as that. In other words, we all have ownership. If we all wear masks, and that's really done throughout the country and people emphasize it, I'm pretty confident the GDP will be higher, the unemployment rate will be lower. That's going to drive the economy as much or more than anything else, and we'll avoid the second wave that everybody's so worried about.
Mm-hmm.
That's why I'm talking about it so much.
Right. What beyond wearing a mask, what other protocols do we need to, what do we need to see to reopen the economy?
So the masks, I don't want to skip over it because it's not happening.
Right.
And if it did, there was a lot of confusion early on, which people have acknowledged, where are masks effective? Is it really that important? And I'm convinced by my own personal conversations with experts, yeah, there shouldn't have been miscommunication, and it's extremely effective. But you got to do it widely. Everybody has to do it. It's a shared responsibility. So what's the second thing? The second thing, which I've spent a lot of time on with other leaders in our communities, if we had extensive testing and contact tracing. Now, like some people say, is that really that important? Here's why it's important. If you had extensive testing with contact tracing, which I think again is uneven, you could localize. When there's an outbreak, you can localize it. What we did in March is we didn't have this capability, so we shut everything. You don't want to do that. If somebody in a business or a school or somewhere else gets it, you want to quickly be able to figure out who they come in contact with, quarantine those people, and then keep everybody else going out there, continuing on in their business. If you don't know why people are getting the disease or who they came in contact with, and you don't have good contact tracing, the default is let's shut down more. Let's do more and that means you're going to have a greater hit to economic activity. So I think some people think, gee, this more tracing is a impediment to opening up. I think it's the opposite. It is an accelerant to opening up because you have confidence that you can deal with outbreaks in a localized way, very micro way, as opposed to we don't know why these people got the disease. We know it's community spread. Let's do a more widespread lockdown, and all that means is you destroy GDP you didn't have to destroy.
Right. So everybody on the call, I'm sure, is concerned about a second wave. How significant, if we were to encounter a second wave, and in some respects we're seeing some indicators of that, how significant is that impact, and how long?
Yes. So we thought, and most experts thought, that as we reopen, we'd have a resurgence in cases.
Right.
I think that isn't by itself surprising. The problem is, does it get to be such a big resurgence that it overwhelms your healthcare system? Now, in the state of Texas, based on everything I see, we're not close in Dallas or in Houston, which have been the two areas most concerning. We're not close to overwhelming the healthcare system. But on the other hand, mathematically, if you keep having increase in hospitalizations at the rate we've had an increase since Memorial Day, by sometime toward the end of July, you might start to threaten ICUs and a healthcare capacity. So you don't want that to happen. So what would be the impact if that were to happen? I'm sure it means the economic impact is fewer people would stay home more. They would not go out as much. Businesses would be more reluctant to bring their people back. Some retailers, Apple made an announcement last week, might want to be more likely to suspend their operations. And though everything would mean we'd have less engagement, and schools, very important. If schools can't open in the fall, a lot of parents,
Right.
obviously, if their kids can't go to school, they've got to be home, and it impedes their ability to go to work, and it's just a ripple effect. And so what's the impact? It means the 8% or more unemployment rate I referred to earlier is likely going to be a lot higher, and it's going to slow our recovery or threaten it altogether.
So Rob, let's shift gears to some of the policy that the Fed put into place. So in addition to cutting the rates, the Federal Reserve, you guys have taken unprecedented action in response to the crisis. Help us understand why certain actions like the Main Street lending program or the purchase of corporate bonds were necessary, were required.
So as we sat there in March, and as the spread of the disease accelerated exponentially, financial markets, we noticed, started to stop functioning properly. And what I mean, even the Treasury market, off-the-run Treasuries, we noticed were not getting a normal bid, or bid-ask spreads were being affected. Mortgage-backed securities, corporate bond market, spreads gapped out, financial conditions tightened. But more than that, these markets ceased to function. They became closed. And so what we rushed to do early on is make sure the Treasury market functioned properly, mortgage-backed securities market functioned properly, and broad money market funds and markets more broadly began to function. Now, and we were able to restore function, sometimes just by announcing a program, we were able to restore function. Then the question is, once you've restored function, how far do you want to go? And my own view is, once we've restored function, you want to show some restraint. And so that's what we're trying to balance. But back to on corporate bonds, which has been an issue, we announced the program, we bought ETFs, corporate bond functioning returned. We found that by buying ETFs, it probably wasn't the best way to do it. So we announced a week ago a change where we're going to buy individual bonds, but recreate an index. And I think that's an example of a program we're going to have to be very attentive, because those markets are functioning. We've had a record amount of bond issuance. And I think my own view, again, is you don't want to do any more than you have to. So we're going to have to watch that. Municipal bond market is another one where we announced a $500 billion program. There's only been one or two issuers, Illinois is an example, that used the Fed program. Most other municipalities have been able to issue away from us, and that we have a backstop rate, and most municipalities have been able to issue better, and they don't use us. That's great. But what we were trying to do is make sure that the financial system worked and the markets worked, because if they didn't, we would have what we didn't want to have is a financial crisis along with a healthcare crisis, and then we felt the unemployment rate would go even higher. The other programs like PPP we talked about, we'll come back to Main Street in a moment, were intended to make sure businesses have had access to capital, they could borrow as a bridge to get through this period, with the hope that at the other end of it, we would have better economic conditions, and this would tide them over. The issue is, again, if we have a second wave, the bridge is going to need to be longer. If we don't have a second wave, the bridge can be shorter and we can do less. And the jury's out on how long this bridge needs to be.
That all depends on the health considerations, right?
It does.
So on the flip side to that, so all of these actions that the Fed has announced, there is concern that some of these recent actions may cause inflation to increase dramatically. On the flip side, can you talk about that a little bit?
Yeah. My own view is, and there was appropriately the same concern out of the Great Recession.
Mm-hmm.
I would say that at least for the next couple of years, while there are individual supply side issues like for food, meat, prices going up, other supply side issues, overall, most of the forces I'm seeing for the next year or two are disinflationary. Okay. In other words, we're going to have lower inflation, not higher inflation. The reason is we've got so much excess capacity. Now, that doesn't mean you won't say, but I'm paying more for this and this. Those are supply constraints, meaning, there's been an outbreak in meat processing plants and meat's going to be more expensive. But overall, as we get through those issues, even with those issues, inflation rate's more likely to be lower than higher. Now, once we get to where we've used up a lot of this excess capacity, which I hope we will begin rapidly to do through this year and through 2021, and we have a lower unemployment rate and less excess capacity, what's the effect on inflation then? And you start having more inflationary forces. At the moment, I'm not seeing it, but I'm attentive to it. But if those issues are gonna emerge, they're more likely to occur probably a couple of years from now. But I'm watching for those, and we should be watching for those.
So are you concerned at all about the rising amount of U.S. government debt?
Sure, I'm very concerned. I was concerned before this crisis happened, and that we had a record amount of U.S. government debt. I didn't think it's sustainable. We've now just ratcheted up to a much higher level, and we've got to issue a dramatically greater amount of Treasury securities as a result of it. And in addition, the Fed balance sheet has gone from 4 and a fraction trillion to now in excess of 7 trillion. And so I'm concerned about all that. What are the side effects? What are the unintended consequences? But certainly we know that annual deficits are going to be much greater. But what's the effect on the currency? What's the effect on the dollar? What's the effect on a whole range of other issues in the years ahead? It's obviously going to affect tax policy, government spending, and it will also have an effect ultimately on how fast we can grow. Does the amount of government debt needs squeeze out private capital that would otherwise invest in productive investments? Those are all the questions that we are asking, I am asking, and we should be discussing. We're trying to take a look at it. We are taking a look at it.
Rob, we've talked a lot, kind of on a national level. Just to take it even broader, are there any global considerations that we need to pay attention to specifically to North Texas?
Yeah, for one, we're the largest exporting state in the country. And obviously, to the extent the world grows more slowly, it's not good for exports. Now, by the way, it hurts us in Texas, but it really hurts Europe. It really hurts, for example, a country like Germany, which has got multiples of the percentage of GDP in exports. But to the extent Asia grows more slowly, China grows more slowly, Europe grows more slowly, it ultimately creates smaller end markets for our exporters and smaller end markets for our companies that are operating around the world. And so it is in our interest to see growth globally do better. And I would say if you look around the world, well, it's an even picture. Some countries have done a very good job on their testing, mask wearing, contact tracing, and I think it's helping. Based on what I look at, it's helping them recover faster. But other countries are doing a much poorer job. But at the end of the day, it's hurting global growth. It's hurting growth everywhere. And so to the extent the world grows more slowly, US will grow more slowly, Texas will grow more slowly.
Rob,
By the
before
way, if you want exhibit A for that is oil. Obviously, oil is a global commodity. To the extent that global GDP is lower, demand for oil is lower, price is lower, less rig count, less CapEx, more layoffs, more bankruptcies, restructurings, and all that.
Rob, you beat me to it. That's exactly where I was going. Before the coronavirus set in, we were already concerned and things were not ticking in the right direction. What's your outlook for the energy industry?
So we produced in the United States 12.8 million barrels last year. We think that when we get to the end of this year, US production will have declined to 10.8 million barrels. So we'll go from 12.8 to 10.8. Now, ironically, the picture is worse than that in the middle of the year, like right now, we've got a lot of production that's shut in. The wells were producing, the producers have actually shut it down. So not only are they not building new wells or doing new rigs, they've shut in. And our best guess is you probably need a price, so let's call it $35 to $40 a barrel for people to reverse a shut in and start producing again. And we're kind of hovering around that right now. We're in the high 30s, $40. By the time we get to the end of the year, we think most of those wells that were shut in will be back producing again. And even with that, we're still going to go down 2 million barrels a day. And the reason we're going to go down is the decline curve in shale is so dramatic, over 50% in year one, that if you're not drilling new wells, you're going to have a natural decline. And so if you look out to 21 and beyond, we're still believing we're going to get into global supply-demand balance based on how fast the world grows and how fast we grow. By sometime as early as middle of next year, the price could approach $40, $45 in anticipation of that. And I think you're going to see supply start to move up, and you'll see production improve. But right now we're in the middle of kind of we're not the worst of it. It was worse a month ago, but we're in a difficult period where suppliers have struggled. There's more bankruptcies, restructuring. CapEx, we think in the sector will be down almost 50% this year. But my guess is over the horizon, as we get into global supply demand balance, the world's going to need more shale and need more production. And you'll probably see growth increase from there. All that's very much dependent again on the healthcare protocols, the path of the virus, and how fast we all grow.
Rob, obviously energy is a significant part of our economy here in Texas specific. Are there any other industries that we need to pay attention to closely here in Texas?
Well, there's lots of them. Now, ironically, as important as energy is, it's down to around 9% of the state's GDP. That probably surprises people that it's not higher. So we become a dramatically more diversified state in the last 30 years. A lot of that is due to migration of people and firms to the states. We have a big tech industry in the state. We have all sorts of broadly diversified industries through the state. We have many big companies, some probably on this call, who've relocated here in the last 10, 15 years. People forget that they weren't originally from here, but lots of companies have come here. And so I would say the thing I'd be most worried about vis-a-vis this crisis is the number of small businesses and the service sector in the state, which is going to recover based on the course of the virus. And that's where, if we sort of hit a wall, that's where we're going to hit a wall.
For the group, I know there's probably a boatload of questions already. We can kind of go to those in a minute. Just one other thing, Rob, I'm just curious to know. We've covered quite a bit of different topics in different areas. So give us an outlook for us specifically here in Texas. What can we expect? And I'm assuming there's a broad range there, right? Because of all the healthcare considerations. What can we expect?
I still think Texas will outperform the country for the foreseeable future. And migration, one of the big trends that's helped Texas is migration of people and firms to the state.
Mm-hmm.
My guess is that, if anything, as a result of all this, may accelerate. It's possible. The big challenges are still the big challenges here. We have to improve educational attainment, early childhood literacy, skills training. And I think that's dramatically more important in the aftermath of this crisis, because Blacks, Hispanics, low income, lower educational attainment workers have been disproportionately negatively affected as a result of this crisis. They're far more likely to have lost their job or have lost income. And we're going to have to work on how to get those folks back into jobs. And I think a lot of that's going to have to come with training and education and improving that.
Mm-hmm.
But the outlook, I think, for Texas is still pretty good. But again, the only thing, if I give one piece of advice, which I've been redundant on this, which fine, is if I could give one piece of advice, and I try to remind myself of it: wear a mask every day. Encourage your people to wear a mask. Model it. That's the one thing each of it. Most of us can't do a lot about testing and contact tracing, but each of us can do something on mask wearing. And I'm convinced if each of us did that, and if our leaders emphasized it more, we'd grow faster in Texas, and this spike we're seeing would be more likely to be mitigated.
You know, Rob, I totally hear you. You know, I came from the Carolinas, and I have a Carolina Panthers mask. I don't know if it's the safest thing for me to be wearing in Dallas. Hey, you touched on the potential for in-migration from other American cities, right? And I've been reading a lot about this. There's folks that are leaving those dense urban centers.
Yeah.
Can you talk a little bit about that influx, the potential to pick up more folks from New York and from LA and Chicago because of the space we have available?
Yeah. So here's the irony is, going into this crisis, the big trend in the United States was young people and people generally wanted to move to cities, denser areas. By the way, that helped Dallas and Houston,
right,
as well as San Antonio to some extent, and Austin for sure. People wanted to move, and they wanted to move away from some of these smaller towns. So there's a whole number of smaller cities in this state, which, you know, we're just struggling. It's probably too soon to judge, but this crisis may change all that.
Yeah.
Or maybe smaller, mid-sized towns, this would be a good thing, might become more appealing. Obviously, Texas has lots of them. And relatively speaking, Dallas is less dense than, you know, a New York City or another city like that. So I'm getting a lot of, I'm getting a lot of phone calls. I always got a lot of phone calls here from CEOs and businesses, but I'm getting more now where people are just rethinking everything. And my guess is, it's too soon to judge, but my guess is that trend may continue.
Yeah, it sure seems like it. Hey, Jeff, any audience questions? I can kind of see that there's a bunch, right?
We do. We have quite a few. Are you ready to go to those, Ollie?
Yeah, absolutely.
Okay, great. First question is from Dan Dickey. Dan, do you want to unmute and ask your question?
Yeah, my question is that traditionally the Fed has always used unemployment and inflation kind of as the boundaries of how they can do stimulative fiscal policy. Are there new metrics because of this pandemic that may limit the Fed's ability to be stimulative anymore, or is it going to be stimulative forever? What's going to stop that?
Well, so we'll continue our dual mandate, which is statutory, is full employment and price stability, and that's not going to change. I would say in this crisis, and I still think obviously monetary policy is a potent force. The issue is just trying to figure out what's appropriate in light of what's going on. In the shorter run, because unemployment is so elevated right now, and inflation, despite isolated cases, is muted, I've spent a lot more of my time, by the way, looking at a lot of other a lot of high frequency data, which is not probably specifically what you're asking about, but mobility and a lot of other high frequency data that gives me a better indicator of where we're heading. But will monetary policy have a key role to play? It'll have a key role to play. But I don't think over the longer run it's as important as fiscal policy and structural reforms that do things like improve education, improve skills training. And in this crisis, it's important, but I think again, the healthcare policies and healthcare execution is at center stage and is first and foremost in driving how fast we're going to grow. Monetary policy can help, but it's not a substitute for doing these healthcare policies, executing them properly.
Next question, which I think will follow up on that response, is from John Davis. John, do you want to unmute and ask your question? All right, I'll go ahead and read it. The question is, with the rapid push the pandemic gave work from home as a norm, do we have any data that can measure productivity at a macro scale versus pre-COVID?
The answer is kind of rough data. I think the thing that always worried me going into this crisis and would worry me now is if you've got a college education, you are far more likely to be able to successfully work from home or to be in a job where you can work from home. And my guess is, while it's not perfect, when we do have data, which we will eventually, my guess is productivity is not perfect, but it's not bad in people working from home. Maybe in some ways it's better even. The thing I'm worried about is there's 46 million workers in this country with a high school education or less, and all the studies I've seen show it is not as possible, is not as likely they're able to work from home. They have to interact, and clearly their productivity was a challenge even before this crisis. It's even more of a challenge now, and they're likely to be in a situation with all these healthcare protocols that they have to do a lot more to be as productive. So my guess is we're going to see a barbell. If you're highly educated and you can work from home, you probably were pretty productive, but a whole swath of workers in this country that don't have the luxury of being able to do that might ultimately, I think, turn out being less productive.
Next question is from Mike Hellquist with BB&T. Mike, do you want to unmute and ask your question?
Sure. Thanks, Rob. I just had a quick question on which industries in Texas have fared the best through this pandemic. If you've noticed any specific industries here in Texas that have actually experienced positive growth as a result of all this.
Yeah, so I've observed, and I won't call out certain companies or industries because I avoid doing that. But listen, all those companies, digital companies, digitally oriented companies that people can use their products or services while working from home. And you can think of some obvious names, given the Wi-Fi and the tremendous demand for broadband. Those companies have worked well. I've been surprised. Listen, law firms, obviously, and there's some lawyers on this phone, consultants, wealth managers, a lot of personal services or professional services. While there's less activity, I mean, I think these industries have pretty successfully been able to adapt and carry on their businesses. And so those would be some examples.
Next question we've got is from Matt Adamczyk. Matt, do you want to unmute and ask your question?
Thanks for the chance, Jeff. President Kaplan, my question has to do with Social Security. I make the observation that the amount of the stimulus was roughly equal or maybe even a little larger than the entire Social Security trust fund. I know you didn't hand over the trust fund, but it was an equivalent amount of money. We also have a lot of people unemployed, so imagine, collections of Social Security, tax is down quite a lot. Personally, I'm closing in on maximum Social Security age, so I'll be on that by the fall. and I have a special needs son who's going to count on the disabled adult child benefit after I pass away. So I'm very concerned about the future of Social Security. And I do this for a living for other families. I have a lot of, do these plans for them. Do you share my concerns about Social Security?
I'd be hopeful and I'd be optimistic. I'd be disappointed if we did not continue a pretty robust social safety net with Social Security being a key part of that. I'm worried though, more broadly, we've got so much government debt. And if God forbid the dollar was ever not the world's reserve currency, you know, we've been very fortunate that we can finance this debt leading even up to this crisis because people want to be in dollars. If that changes, which it could, because of technology, other events, are we going to have a harder time financing all this debt that we've built up? And it's going to squeeze us in our ability. We're going to have to make some very tough choices on government spending and what we spend on. But I would hope even with that, I think everything I've seen suggests having a very strong social safety net, Social Security being central to that, is critical to the country. And I'd be more thinking that we're going to have to make some tough choices on other things. Now, might we means test Social Security, where if you know, and other things, I guess I could see that, but I would hope that nothing would happen would jeopardize that program, and I would be hopeful. I wouldn't foresee that. I don't think it'd be in the interest of the country.
Thank you.
Thanks. Next question is from Price Bashir. Price, do you want to unmute and ask your question? Okay, I'll ask it. Price's question is, given the housing shortage in Texas, how does the Fed see the current situation impacting single-family housing in the short run and the long run?
So, I mean, I've noticed and I've watched with great interest, and I've talked to a lot of home builders, and we may see part of this behavioral change we talked about, moving from cities to the suburbs. At least so far, we're seeing pretty good demand for single-family homes, which tells me that you know, maybe we're going to see some behavioral changes. And I guess what they're asking also in this question is, what about the lack of supply? And I could see where that's going to be an issue. I could see where demand for single-family homes and living outside cities, the attractiveness may increase. And so I think we'll have to continue talking about all those issues and questions.
Thanks. Next question is from Eddie Reeves. Eddie, do you want to unmute and ask your question?
Thank you, Mr. Kaplan. Welcome to. Thank you for getting on this call. I can now finally tell my friend Scott Richardson we actually talked.
Good. Oh, good.
Listen, yeah, even in the best of times, the level of income inequality and even more acutely wealth stratification has gotten to what I think are pretty dangerous levels in this country, and especially so in Texas. And so in this current environment, I can't even imagine where we're going with that. What role does the Fed have to play in that? And I know you talked a lot about retraining and education, and that's been the kind of the default answer to this question for 10 years. It's not really working. And I think that's because, quite frankly, a lot of most influential people in the society don't want to invest the resources or target them that way. So what's the real answer to getting out of this?
So to your point, going into this crisis, so if I went back 4 or 5 months ago, the only good news was the Black and Hispanic level of unemployment and an overall level of unemployment were the gap was narrowing. Now, why was that happening? Part of it is we'd made a decision at the Fed to allow the economy to run hotter, thinking that there were more underrepresented groups on the sideline that running hotter might pull them in. And then what we also thought is if you get somebody back into the workforce and they can stay in for a year or two, they start developing the skills and everything else where they'll stay in for 20 years. So we thought that was a great development. And yes, going into this, I am a big believer, based on my background, early childhood literacy, and I think those programs do work, and improving secondary education. So I was a big proponent of education reform in the state of Texas, and I was very impressed that it got passed. And the work that Commit, which I'm biased, I'm on the board, that what Commit and others have done, I'm a believer that that's moving the needle. And I've been impressed with skills training, but it's uneven, to your point, in the United States. I think Dallas Community College has done a great job, but it's uneven. But I think it does help. Now, into this crisis, all the progress we made in the last 10 or 12 years, I hate to say, I'd say this, we're gone backwards. So we now have the gap again, in that Blacks and Hispanics were far more likely to lose their jobs. Low-income workers who just got into the workforce were far more likely to be out of it. And now we got to climb this damn hill all over again. And so in the first step is to save as many small businesses and service sector businesses as possible, and help them get on their way, and so that we can retain more jobs. But my fear is, to your point, even after we've done that, people are going to decide to be smaller. They're going to right size. They're going to have fewer workers, and we're going to have to work to help people get back into new jobs. And I think we've got a long road here. What can the Fed do? The Fed's got some tools, but I think a lot of this is going to be structural reform and targeted fiscal policy. But the first order of business is to agree that you want to close this gap. And I believe that it's worth agreeing that we want to close this gap, and then target your policies to try to do that. If you can't agree up front that that's what you're trying to do, I can tell, having worked in the public sector for 5 years, it makes it a whole lot less likely you're going to be able to do it. But there's lots of nonprofits, there's lots of people. I'd say the business community I've observed in Dallas very much has put their money where their mouth is and their efforts to try to address these issues. And so, but we got a long road here to climb back, and that's really discouraging. But we can do it.
Thanks very much. Next question is from Gabrielle Carlson. Gabrielle, do you want to unmute and ask your question, please? Okay, I'll read the question. The question is, what is your outlook for the commercial real estate industry? Do you foresee more companies continuing remote working, thereby reducing the need for office space?
This is an interesting one, in that I don't know. In that I talked to a bunch of companies who say, we may actually need more space because we're going to have to distance people and everything else. That's one group. Another group has said, you know what, we're not going to need as many people. And we sort of concluded we don't need anywhere near as much space as we had before. And I think I think it's too soon to tell. It's too soon to tell. I mean, in that I don't know how much office space or commercial space people are going to need. It's clear that retail space, you know, we as a country, all the statistics I saw showed we were over retailed versus other countries in the world overstored. And my guess is this pandemic is going to accelerate the trends to that being changed, and that's going to have a big effect on retail properties, and already is, obviously. But the short answer is I don't know. I'm watching it carefully.
Great. Next question is from Tony McGee. Tony, do you want to unmute and ask your question?
Yes, thank you, Jeff. Thank you, President Kaplan, for taking the time to share your insights with us. I wanted to go back to a couple of things you said earlier. You talked about fiscal policy, and then you questioned whether there would be sufficient faith in the federal government to be able to finance the debt. So I've been hearing a lot about century bonds or perpetual bonds. Do you think there's going to be a strong market for those? And if so, are they the way out of this pandemic?
So when I say it won't be a lack of faith in the U.S. government, it'll simply be that people they stop overweighting as dramatically as they have to the dollar versus other currencies. You know, right now there's a big global overweight to the dollar. You don't need people to stop or lose faith in the United States. All you need is for them to say, we're going to reduce that overweight just a little bit, okay? And all of a sudden the cost of our debt goes up, to your point. So do I think terming out is a smart thing? Yes, I do. Depending on what your company is or what your entity is, or if it's the government, I would think that terming out, if you can do it, including for the U.S. government, would be a very valuable thing to do. I don't do that, and it's for the fiscal side of the house or for companies, but I would think that given where rates are right now, it's pretty valuable. To have rates this low is a pretty valuable thing.
I didn't mean to.
Where's your office, by the way?
I'm Quorum and the tollway. That's the tollway behind me.
Yeah, it's a nice view.
It's a great barometer of business because it's so quiet. But I didn't mean to seem to be denigrating the U.S. government. You can probably tell from my accent that, you know, historically we have few issues with the American government. I just didn't know, you know, 100 years is a long time.
I know.
Any government.
And by the way, it's been done before. And I used to be an investment banker, and we used to have looked at the 100-year bond, and I was shocked how there's buyers for long-term assets. So those long-term assets.
Okay.
So you've been watching traffic. Traffic is still a lot slower than what it was pre-crisis.
Yes, barring accidents.
Okay, got it.
There's been a couple today.
Okay. Picked up in the last month or two, though? I mean, I watch every day myself.
It's picking up, but, you know, rush hour used to, you know, about a month ago, rush hour was just a few cars dribbling down the road.
Okay. And now it's much more.
Yeah.
Okay.
All right. Hey, well, thank you all very much. We really appreciate it. Thank you very much to Ali Chandhok for being his typical masterful moderator. Thank you, Ali. Thank you to the Dallas Business Journal. Also want to thank Rob. Rob, thank you for these enlightening perspectives on the economy and everything that's happening. For those of you who don't know, Rob has done a masterful job over the last 5 years of really connecting to the community. He has a series, a program called Global Perspectives that you might want to check into. But there's a lot of information coming out of the Fed, very connected to the community, and we really appreciate that. You know, on behalf of the North Dallas Chamber of Commerce, we'll be making a donation in Ollie's and Rob's name to the North Texas Food Bank in your name. So thank you for your participation today. I also want to thank again our sponsors, Capital One, Hewitt Zollers, and Benefit Mall. And last but not least, I want to thank all of you for your interest and engagement in these very important issues that we're facing in our community today.